Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And I wanted to talk about short-term trading in today's webcast, and specifically with short-term traders, very commonly they realize what they're actually doing is trading that tug of war between buyers and sellers. And for that purpose, there's a number of technical traders that will turn to an indicator known as the balance of market power indicator. That's the tool we're going to be talking about today. We're going to be talking about how it's built, how it might be used to plan and place an example trade. We're going to be combining it with a different indicator. Should be a great discussion. Before we get to any of that, though, I first want to say hello to everybody who's chatting in. I see a lot of familiar names out there. I already see somebody saying, hey, it's my first time here, so welcome to you. But hello there, Jack, Jatine, Mary, Jay Richardson, Hope, Chris B, Gary. Who else is here? Let me scroll around here a little bit. Bill, hello. Andrew, Sharon, and on. Ted and Ray, and on that list goes. Thanks, everybody, for joining us week after week. I do appreciate your attendance, your contributions to these discussions. If you are here for the very first time, I do want to welcome you as well. And if you're watching on the YouTube archive after the presentation is concluded, we'll enjoy that recording, but be aware that you're invited to join us in the live stream webcast. This is a Friday webcast series, and we kick things off promptly at 1 o'clock Eastern time. We'd love to have you here in the live stream audience. And as a very special treat for those that are here in the live stream, my very good friend, longtime peer, Scott Thompson, is going to be hanging out in the chats. He's going to be addressing any questions that I can't get to during the flow of the presentation. Great to have Scott on board. And also, just as a heads up, you should be following your favorite presenters in between these live streams on X. So if you have if you have an account on that platform, give us a follow. You can follow me there on X at Cameron May CS. So let's get into this discussion. As we do, of course, there are risks associated with any approach to trading or investing, including technical approaches. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including loss of principal. Okay, so let's talk about this indicator. I think it's going to be new to a lot of you. How many? Go ahead and chat in. Let me know. Are you familiar with this indicator known as the balance of market power, sometimes referred to as just the balance of power, and it's commonly abbreviated to just BOP. So, yeah, are you familiar with the balance of market power indicator? Well, regardless of your level of familiarity, I want to make sure that everybody can follow the full discussion. So the first thing that we're going to do is apply the indicator to a chart. We're going to talk about how it's used. And this one, in my view, kind of pretty straightforward indicator. So we'll talk about how it's built, what the implications might be for fluctuations in this indicator, how it may generate signals for a trader, and we're going to make sure that we plan and place an example trade before we're done today. All right. So let me look over here. I'm seeing no, never heard of it. No, sir. No, new to me, not familiar. Gary says yes, but Tommy, Jack, Scott, nope. Okay. Yeah, let's get acquainted. So let's go right to the Thinkorswim desktop platform. And we're just going to start with the S&P 500 here. And I'm going to go right up to the list of studies. And we're going to look for balance of power. We'll just start typing in the name. That'll narrow down the list in the menu to just those including the word balance. And we're going to choose balance of market power. We're going to add that to our chart. And there are a couple of basic elements that are being revealed about the indicator right here. Notice it says the word simple. I think some of you are already going to know what that's referring to. And 14. Others of you will also guess what that means, but I'll talk about those in more detail. Let's click Apply and click OK. And I wanted to show you the default appearance of the indicator, but then I'm going to switch it over to one that's probably more commonly used. By default on Thinkorswim, our indicator is displayed as a series of histogram bars. So it's going to look similar to like your MACD, something like that, where we have green histogram bars rising above the zero line. We have red histogram bars falling below a zero line, right? But I will say it's probably a bit more traditional to look at this as a line chart, an oscillating line chart. I'm going to make that change, even though I will say it doesn't matter. They both give us the same information, just with a different visual presentation. But let's go up here to the little flask icon. That's our edit studies icon, and let's edit this study. So I'm going to go over the little gear icon, or little gear, and let's change this to draw this instead of as a histogram. Let's draw this as a line, an oscillating line. Click OK, click Apply, click OK again. There we go. That's a little bit more of a traditional view of the balance of market power indicator. So let's talk about how this is constructed. Now, as I said just a few minutes ago, this one's, I think, fairly straightforward in its construction. There are lots of indicators out there that use all sorts of sophisticated algorithms to finally work out the tool that's being displayed on the chart. This one actually starts with a basic assumption. Here's the assumption. If we're trying to measure this tug of war between buyers and sellers, this indicator puts a lot of weight on the colors of the candles. It really comes down to the a tug of war of white candle versus red candle, green candle versus red candle, depending on how you have yours displayed, white or green, whatever. But also the candle size plays a vital role. So lots of big white candles are going to cause this oscillator to rise. Lots of big red candles are going to cause this oscillator to fall. But if there's kind of a balance between the two, we're going to see this oscillator move more towards zero, which means that the buyers and the sellers are in balance, or at least that's the interpretation here typically. So here's how this is constructed. I'm going to type out the algorithm. Let's get rid of this old information from a previous webcast. And we're going to do calculating balance of power. Yeah, I know it probably should be called BOMP, but it really depends on whether we're calling the balance of power or balance of market power. Both same indicator, so it doesn't matter. But here's the whole equation. Okay, get ready. Take the closing value of a given day and subtract the open. Once you've determined that, you take the high of that day and subtract the low. So what is this really doing here? To calculate the balance of power initial value, the close minus the open, what is that? Well, that's just the size of the body of the candle. Sometimes you get small bodies and very tall candles, so they have long wicks and tails. Other times you have very large bodies in tall candles. And so there's hardly any wick, hardly any tail. Those are given a greater emphasis in the balance of market power indicator. But we take the size of the body and divide it by what? High minus the low is the range. It's just the size of the candle overall. So literally it's the size of the body divided by the range. Now, because we always start with the close and subtract the open, sometimes the close is above the open, which creates a positive value. Sometimes the close is below the open, which creates a negative value. So sometimes we have negative bodies, sometimes we have positive bodies. Now, the divisor in this equation, the high minus the low, that's always going to be a positive value. You're never going to have a low price that's above the high price for any candle. So this will take the bodies, sometimes positive, sometimes negative, divide them by the range. And so sometimes we wind up with a large positive number, sometimes a small positive number, sometimes a large negative number, sometimes a small negative number. But then what we'll realize is if we just put this on the chart, we'd notice it would change very rapidly. Sometimes on a given day, for example, it might go from a very positive, large value to a very negative, small value, or a very large negative value. And we would see this oscillator just jumping dramatically back and forth. So we need to smooth that out. Tell me, technicians, how do we smooth out day-to-day dramatic changes like that? What is a commonly applied charting technique to smooth out volatility on a chart? Well, just like we might apply a moving average to prices on a chart to smooth out the day-to-day volatility, we apply a 14-day simple moving average to these values. Yep, that's what we do. And this is that 14-day simple moving average oscillating up and down. So this is really intended to gauge over a period of about 14 days the general trend of this tug of war between buyers and sellers. It is by nature, by default, a short-term indicator. So typically this is used to construct shorter term trades. But this can give us some interesting insights into that tug of war, because I want to look just on the S&P 500 at the last 14 days. Let me hide this for just a moment. Now that we understand how this indicator is built, let me show how it may give us different insights into the way that price is behaving. Look at the S&P 500. This was literally, let me put an oval around the day from 14 days ago. That's 14 days ago. What has the S&P 500 done over the last 14 days? It's just gone up and up and up and up. But an interesting thing has happened here. During those 14 days, let me zoom in on that time frame. So there we are. During those 14 days, have we just gotten a whole series of white candles? Nope. We've had 1, 2, 3, 4, 5, 6 red candles. So 8 white candles, 6 red candles. There's actually more balance in the tug of war between these two titans of power than the trader might think. Also, look at the size of the candles. We have wide ranges, but quite commonly small candles. We have a little white candle here, little white body there, little white body there, little white body, little white, little white. So 6 of our 8 white candles, comparatively small. And according to this oscillator, that would show a balance of power despite price going up over time. Chris is saying low volatility too. That's pretty typical. Yeah, Chris, for stocks going up. Now, there have been a couple of larger white candles, but there have also been a couple of comparatively larger red candles. Interestingly enough, this indicator would suggest that power is relatively at balance despite prices going up. And for a trader here using this indicator, it might just indicate this may be not a time to assign a great deal of weight to the otherwise apparent bullishness on the chart. Does that make sense? The bears have more power than we might think just looking close to close. All right, so our oscillator has actually come down close to zero, close to a balance of power. It popped up a little bit today because we do have a white candle that's come in and kind of it's gone from, as of yesterday, we had 7 reds and 7 whites. Now we have 8 whites and 6 reds because 1 red has dropped off and it's been replaced with 1 white, and it's caused the balance of power to shift upward a little bit. So that's just sort of a deeper discussion of the way that this indicator may reflect things differently than just looking at the price chart. Now, that's all interesting, but what traders really commonly use this indicator for is to identify when the balance of power has shifted unusually far to extremes in one direction or the other. Those extremes tend to be short term in nature. So when the bulls really gain an extreme control, typically they lose that overbalance of power fairly quickly, and there is a reversion to the mean. Also, if the bears really gain control, there typically tends to be a reversion to the mean in that balance of power. So for a technical trader, let's say they're looking for new bullish entry points, possibly, conceptually, the worst time to take new entries is when the bulls already have an overbalance of power. Maybe conceptually a better time to enter is when the bears have temporarily seized an overbalance of that power control. Does that make sense? I hope it does. Don says, Cameron, effectively, isn't this a smooth emotional metric, body divided by range? Could be interpreted that way, John. If we're looking for extremes in behavior, those extremes can be driven by extreme emotional, I guess just emotional extremes. Could be greed, could be fear, right? But here is a typical and technical interpretation of when we've reached extremes, and it can be different from an index to an individual stock. For an index, we tend to not see quite those emotional extremes, John. So the trader doesn't typically look for quite as far a departure in a bearish way when looking for a possible bullish entry. I know that can sound counterintuitive, but yeah, the bull is looking for a bearish extreme as opening that window of potential opportunity. So if we look to define an extreme, well, this is a range-bound oscillator. So 0 is balance. Really, if we get much below about minus 0.15, that means basically 15% out of balance. Can't ever go below 0, can't ever go below -1 on this indicator. That would mean that the bears are in absolute complete control. That'd be the typical interpretation. Can't go above 1. All right, so -1 to +1 are the theoretical ranges, although I can't think of a time when we ever see that unless you just have something that's absolutely collapsing towards 0, or unless there's just some crazy amount of positive sentiment toward a stock. But in any case, just getting down to -0.15, that's an imbalance of about 15% on the S&P 500. That can be an indication, whoa, wait a second, something comparatively extreme is happening here. And if we can just get that balance of power shifting back the other direction, that could be an entry signal for our trader. So let's look at examples here. So here's our 0 line. And if you can look really quite closely, there are some faint dots. Now I could have adjusted my settings to make those dots a little bit more prominent here. Let me see. Let me see if I haven't done that in a long time. I'm going to see if I can do that just so that everybody can see it a little bit better. Let's see, that's going to be on our appearance and grid. Let's make that a little bit darker. But if we crank that up to a charcoal gray, click OK, click apply. That helps out a little bit. You can see little dots a little bit better now. But those dots actually represent a -2. Now, anytime we get close to -2, then obviously we've gotten below -1.5. But really, all we have to do is point. And if we look over here at the intersection with the horizontal portion of our crosshairs, we can see when we've gotten below -0.15. And it only happens a few times a year. There's one right there. There's one right here, and there was one example back there. Now, I will say a technical trader probably would not have done anything with this one or this one. And that's because of the trend leading into the appearance of those two. Typically, this is an indicator, like with so many oscillating indicators, it's most commonly paired with a trend indicator as a filter to hopefully help us avoid, let's say, false signals. Now, nothing's perfect. No trade system is perfect, but that's a common filter. But yeah, let's look at this recent dive. We got down, if we want to see the absolute value, what we can do is just point at a given day and then look up here, and this will show us the actual value, balance of market power. There's the numerical value. So if I point at that day, I can see we got down to -0.187. And the signal is when we reach an extreme out of balance scenario, and then there's a shift in that balance of power, literally meaning the indicator tilts upward. So that would be on this day. Let's draw an oval around that. When we got that upward tilt right there, that was a signal to our trader. The bulls, the bears have gotten out of control with their power, and the bulls are starting to resume control. And really, there was a signal about right here. That's where that lines up. Now, in this case, that was a pretty good quality signal. Let me get rid of this one. This is just reference point for 14 days ago. We're using the ovals for a new purpose at this point. Let me see what questions we have so far. So does a green line generally mean a bullish sentiment and red bearish hope? That's actually not a bad interpretation of this indicator. For some traders, they'll see anything above 0 is just it's just a persistent bullish trend. Yeah, so this is bullish, but there are times when things can get maybe quote unquote too bullish. So if we're freshly above 0, maybe that's not so bad. But if we've reached an extreme, and on the upside of things, in a bull market, commonly an extreme is identified as being above positive 0.20. So Agariba says, is this similar to CCI? Well, this is an oscillator like CCI, so it's similar in a lot of respects to CCI and RSI and stochastic and MACD. All of those oscillate sideways along a horizontal axis over time, reaching highs and lows. So yep, it does definitely share some similarities, but it's definitely different in its construction, and even though there are similarities in the general interpretation. Ray says, can we use divergence? Actually, Ray, yes, that's the second way that a trader might use this indicator. And by the way, kind of a dark omen, at least through this lens, for the S&P 500 at the moment. But let's talk about the fun stuff first. So we had a signal here. I said a trader probably wouldn't do anything with this one or this one, but very likely this one back here, where we got below minus 0.15 and then started to rally right there. That was actually a signal that things may be ready to shift upward. There's a shift in the balance of power right there. And in this case, another decent quality signal. So why might we ignore these two? Well, it's because of the trend at that time. So there are a number of different ways that a trader might define trend. One common way when using short-term signals that are quite sensitive to price changes is to pair up the oscillator with a similarly sensitive trend signal. So what we'll do today, for our example, let's use our maybe familiar 50 versus 100 comparison. Let's go up to the edit studies. I'm going to use an exponential moving average. Those tend to be a little bit faster than our simple moving average, a little bit more sensitive. So let's go moving average exponential. Let's add that twice. And I'm going to put on a 50. That one's going to be a little bit far faster indicator. So let's change that one to red. And let's switch the second one to 100. We'll leave that one green, but I realize that some people, they have difficulty distinguishing between the two colors, green and red. So let's make the red one, or the green one, the shorter term one, a 3 out of 5 for thickness. Click OK, click apply, click OK again. So here we have a 100 period exponential moving average representing kind of a longer term trend. And then we also have a red 50 period exponential moving average representing potentially an intermediate term trend. And the trend confirmation here would typically be, this is a common interpretation of these two indicators when used in combination with one another. If our intermediate trend line is above the longer term trend line, then that might be a bullish trend confirmation. If the intermediate term trend line is below, actually, I've gotten a little bit ahead of myself. A trader might have actually taken this one because at that time, the 50 was still above. All right. Yeah, that one might have actually generated a false signal. It was actually an okay signal for a little while. But if we hung on for too long, if we didn't have a downside exit plan, I would say this one probably, I don't know, might have hit targets, but may have come up short. Bruce says, I thought balance of power was buy side imbalance versus sell side. Basically, Bruce, that's the concept is buyers versus sellers. Now, it's not actually looking at that sort of a granular level, order by order, tick by tick, trade by trade. Instead, it's using candles. Okay? All right. Anyway, but so if we were to just bottom line this for the S&P 500, well, the 50 is above the 100. There's a bullish trend confirmation. Our balance of market power is a little bit far above like an extreme bearish imbalance. So not an ideal entry if a trader is looking for that. But is this screaming look out ahead? Not really. A trader might just say, well, it's not giving us a fresh entry signal, but it's also not signaling that things are overbought at this moment. So they might still be inclined to go ahead and place new bullish trades for maybe for balance of market power entries, maybe for some other reason. Pardon me. Now, if we get above 20 and start to turn back down again, though, that may be a signal that the stock might, or that the markets in this case, may be hitting short-term highs. Doesn't always work out that way. You can see here, balance of market power started to head down. The market's continued to climb, though. It's not perfect. There were other times when it did a much better job of identifying reversal points, like here and here. You can see we really struggled to go much higher as our balance of market power was in that overbought range. Here was another one in the short term. So if we got in on this signal here, and we start to see this get above 20 and fall, that could be a bearish signal for the stock, or at least or for the stock market, or at least just cause some hesitation. Now, this actually is a pretty fair introduction with one final thing that we need to cover, but we need to go and apply this to an individual stock, and we're going to change the interpretation of the signal just slightly. Okay. But who was it that asked? Yeah, Ray asked about divergences. What in the world is a divergence? Well, a divergence is when price is hitting higher highs. So here, up to here, up to here, prices are moving and creating higher highs, but our oscillator is making lower highs. That actually is a pretty classic example of a bearish divergence. And what this might mean is that previously there was enough bullish enthusiasm to drive things to extremes. Now there's still bullish enthusiasm, it's just not able to take us up quite as high, according to this oscillator. And it really might just come down to these day-to-day. The candles are just not as convincing. There were lots of white candles on this move. All right, there's kind of a blend of white and red on this move. Still accomplishing moving us higher, but it's not as bullish. And for some traders, that might mean that there is a significant shift in the trend ahead. It may result in an ultimate change in the trend, or maybe it's just a significant pullback. Is that a guarantee that that's what's going to happen? Nope. But this may cause a technical trader of the balance of market power some cause for at least hesitation. All right, so with that learned, and we just literally call that a divergence because price and the oscillator are diverging in their behavior. Now let's go apply this to an individual stock. And how about we use, let's use BR. There we go. So with BR, you'll notice that we've had a few examples of where this oscillator has reached fair extremes, but with individual stocks, there tends to be more volatility than on an index. And so the recognition of an extreme typically includes a slightly more extreme. Can you forgive me for that? Yeah. What we're talking about here is that getting down to minus 15 might not be quite far enough. It's enough for when we're looking at a basket of stocks like the S&P 500. But when we're looking at an individual security where there might be some more inherent volatility on a more regular basis, that might not be a true extreme. So very commonly that's extended down to a minus 20 on an individual stock, right? So if it helps, let me just draw in a line. I know there are dots here. If you can't see those dots, I can help you with the dots. Let's just draw in a line right here. And you can see that extremes don't happen very often, and that's because they're extreme. If they happened all the time, it would be considered normal, not extreme. So here we see our balance of market power get down below minus 20, and then there's a shift in that balance of power, and it came right there. That earnings announcement seems to have spurred it. White candle, interestingly, our 50 is above our 100. That would be a fairly classic entry signal on this oscillator. Another one right here. It looks like our entry signal was here. This one didn't pan out immediately, but did a pretty good job of calling relatively close to that bottom. Yeah, we snuck down maybe another couple of bucks over time, but more upside than downside over that short-term immediate horizon. And now the trader here might have had to wait until very recently. Look at this. We finally snuck back down below that minus 20. But I want to look up here at our trend lines. This is one of the things about these oscillators, using these as a signal. Quite commonly, they may signal to the trader, hey, buy the stock even though price has slipped below the 50, even though price has slipped below the 100. this would still most commonly be interpreted as a legitimate entry signal. Now, maybe not today, because right now our oscillator, if we zoom in, is still falling. It's below minus 20, but it's still going down. What the typical signal would be is if we just turn upward. It doesn't have to get back above 20, it just needs to turn upward. Back above minus 20. And that would typically be accompanied by maybe a little bit more reassuring candle than this big red candle that we're seeing right now. I think you can see, by the way, why that balance of power has slipped so far below zero. Look at those big red candles. There's a little one right here. Compared to the range, this one wouldn't have had much of a negative impact, but this one would have. This one would have. This one pretty good, and this one as well. This big wick still sort of diminishes this one. All right, but there we go. That's how we might interpret our signals for entry on an individual stock. When might a trader take profits? Couple of different ways the trader might take profits here. Number one is if we have a legitimate entry, they may wait for the oscillator to get back up above plus 20 and then turn. So this might have generated an exit signal right here. Now this one did a great job on this in this case. It's not always that textbook perfect. That's a pretty good exit signal. All right, we had another entry here. We snuck up above 20, and did we start heading down? Yep, I think a trader may have actually taken an exit right here on this day. That one would have been disappointing. Yep, so it's not always perfect. Right there, that little tiny tilt downward. So for today, maybe we wait for that. Now, okay, Bruce says, yeah, what are those green and red lines on the chart, Bruce? These, if you're ever wondering that, what you can do is look up here at the top of the presenter's chart, and it'll tell you this is an exponential moving average for a 50 period. This other one, the green one, is an exponential moving average for a 100 period. Okay, there you go. Little visual cue for you there. But waiting to get above positive 20, it can be challenging sometimes. Quite commonly, we'll wait through a bunch of choppiness before we ever get there, and it can take quite a while. Now, a second way that the trader might plan their profitable exits, if profits occur, is to just look to recent highs. With so many oscillators, when we've reached a lower extreme, it's because prices have come down. Well, that creates a previous high. So before each of these lows, you're going to look back and be able to see previous highs. There was a previous high right here before this one, and before this one, previous highs right about here. So the trader may have decided, if I can just get in relatively low and then just get out up at those previous highs, that's a common approach. Now, not every trade works out. Like this one didn't work out. Where might the trader take their losses? Sometimes a signal is premature, the stock continues going down, it's reached an extreme, but it still has more fuel in the fire, or more fuel in a tank, driving it lower. Well, when that signal is generated, the trader may have a plan to exit just below recent lows. A couple of percentage points, a couple of dollars below the low in the case of low price securities. In the case of these higher price securities, probably more commonly a couple of percentage points, 1 to 3 percentage points, because going $1 or 2 or 3 on a $200 stock is hardly any wiggle room at all. So, yep. In this case, what we'll probably be doing with today's trade is going 2% below recent lows. But there is an example complete strategy for trading using this balance of market power indicator. So let's go find a stock that's showing a signal that's very fresh, and let's trade it. So obviously, if we want to look for fresh signals, we could just go over to our list of stocks. Maybe we go to a watch list. Maybe we go to the S&P 500 to start working through these one at a time. That could take a little while. So instead, what we're going to do is a scan, and this is going to be a technical scan. And technical scans are only available on the live platform. So I'm going to switch over to the live platform. Bruce, not quite sure what you're asking there. What's the 52-week HV? Anyway, let's build a search for stocks that are showing recent BOP entry signals. So what we need to do is look for stocks that have the 50 above the 100 and look for a balance of market power value that has fallen below minus 20. All right, now that we know what we're looking for, let's plug that into Thinkorswim. So here we're just starting with the scan tool. We're not going to be using any of these stock scans, although I am going to direct this to let's just look in the S&P 500 for stocks with recent signals. All right, so let's get rid of these filters, and we're going to add instead some study filters, some chart filters. So this first one, let's edit it. We're just going to delete the ADX crossover default, and let's add a study condition. And specifically, our study is an exponential moving average. So let's choose moving average exponential, a value, the 50 exponential moving average. And we're looking for that to be greater than, in a study, another exponential moving average. You tell me, we want the 50 greater than what? 100. And we don't want that sometime in the last, we don't want that sometime in the last 10 days, so it could be, it's below, the 50 is below 100 right now, but it was above the 100 10 days ago. No, we want that to be happening right now within the current bar. Pardon me. So let's click Save. So first requirement of our scan is going to be that among S&P 500 companies, we want to see those where the 50-period exponential moving average is greater than the 100-period exponential moving average. All right, we'll click OK. There we go, greater than the 100. Now, the second indicator, let's click on our little edit icon, delete the ADX default. Let's add a condition, but in this case, we want the study, that is the balance of market power. And we want that to be less than a specific value. I really like how these technical filters are built. To me, they're very intuitive. Right? We just need to tell what study, where do we want it? Well, we want its value to be below minus 0.20. The minus is important, and the 0.20 is important. We don't want it to be below minus 20. It's because there isn't. We're not going to see that. It's not possible on this indicator. We need it to be below minus 0.20, and we want that to be the case right now. Today's bar needs to be below that value. Okay, so let's click Save. Let's click OK, and let's scan. Let's see how many companies out there are currently in that scenario. Now, I want to show a variation on this tool, but at Boeing, let's see what's going on with Boeing. Actually, let's leave our scan there, and I'm just going to pop over here to our paper money, and let's type in BA. And what we'll see with a lot of these, the 50 is above the 100, but our red line is still going down. A customization that we might make to this scan is, let's edit this and say, you know what, instead of it being below minus 0.2, let's edit that and say that it has recently crossed above minus 0.2. We might not get that today, but let's expand that out a couple of bars. Let's click Save, click OK, rerun that scan. And this is interesting. So we have Broadcom, we have Oracle. How about we look quickly at Oracle? Here's Oracle. You'll notice it recently went down below 20, minus 20, but popped back up above that. There is an entry signal. 50 is above 100, and our oscillator has just risen above that minus 20, minus 0.20. So let's trade this stock. Now, we could just put on this trade and wait for it to get up above a plus 20, plus, I always call it plus and minus 20, but I try to be more accurate here when I'm talking to someone else and trying to teach a concept, plus 0.20. But I think for this example, let's just shoot for previous highs. There's our previous high right there. Looks like that's right at 345. Where are our recent lows? Recent lows appear to be right below 290 or 291. Let's see precisely where that was. Low was, yeah, about 292. So if we give that a couple of percentage points, that would be about $6 below 292. That would have us out at 286. So there we go. Target of 345, stop of 286. Let's go place our trade. Let's go to our trade tab, right click on the ask price. Let's put in a custom buy order with an OCO bracket. So in this webcast series, we typically have spent about $5,000 on each trade. So 10 shares would be about $3,000. How about we do 15 shares? Or what if we just do 20? It's going to be about $6,000. That's okay. We'll do 20 here. Link those together. Let's put in a market order with a target, a limit order up there at 345, and a stop down at 286. We're going to make those good till canceled on those two sell orders. There we go. Let's click confirm and send. Buying 20 shares of Oracle at the current market price. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. We're not guaranteed that we're going to be paying right around 303 for these shares. Our stop is at 286, but with stop orders, there's no guarantee the execution price, the amount that's actually received if we sell the shares, there's no guarantee the execution price will be equal to or even near that activation price of 286. No commission on this trade, but there can be on some types of trades. Let's send that order off. There we go. Bought at 303. We got about $42 of upside potential, maybe about where do we put it? 286, about $17 of downside risk. Obviously, that stop's not a guarantee of a maximum of 17. Could be more than that if we gap dramatically downward. But everybody, we've accomplished what I set out to do today. I knew this was, you self-identified saying this was a new indicator for a lot of you. So I wanted to talk about gauging this tug of war between buyers and sellers using the balance of market power indicator. I hope you really enjoyed that discussion. I really like exploring these new indicators with you. We've even paired that up with a second trend indicator just to create an example trade system. This is what we do on Fridays. So I hope that you'll put it in your calendar to join me on Fridays. We'll follow up on this trade. Along with our SMCI trade, I was going to follow up on that. I'll let that work. It's actually doing fine. I'll just bottom line it for now. Stock has been rallying off a low, so we're good there. But we'll take a look at that next Friday. But everybody, you need to take advantage of all of the educational resources that are made available to you, or at least be aware of the educational resources made available to you by Schwab. So number one is if you're here for the first time, if you haven't subscribed to our channel, make sure you do that. Our channel is where we house our playlists of all of our previous webcasts, not all of them, but the vast majority of them. So you can find those playlists right here. For example, if I click on playlists and I go down about halfway, we'll see right there's my advanced charting techniques playlist. And I can see if I click on that, I can see previous discussions. So we talked about our trend value momentum trading system last week. You can go back and revisit that there. Also on the channel, you can join our live streams and you can do searches for topics of specific interest right here. Second suggestion I would make to you is make sure that you're following us on X. You can follow me on X at Cameron May CS. Matter of fact, I got to throw this question out for you. I just asked my followers here. How many of you know which of our coaches have been with the team for the longest? I've been doing this. I started my coaching career more than 20 years ago, and yet I'm not even close to being the most veteran. Which coach do you think is most veteran on the team? Connie, Brent, Ben, or James? Answer just if you reply right down here. I eventually will reply to everybody and tell them whether they're exactly right or not. So thank you, I appreciate that. Everybody, RC, glad you appreciate the class. I definitely appreciate everybody that's already clicked the thumbs up button. That's always appreciated. That That gives a boost to your presenter's webcast in the YouTube algorithm. It also gives us a nice pat on the back for a job well done. So if you enjoy one of our webcasts, make sure you click that like button. It always helps. Hey, Scott, thanks for helping out chat. I always like to do a quick swing back through that chat, make sure I didn't miss anything. Like a survey? I don't think there is one. Nope. All right. Everybody go enjoy your Friday. Enjoy your weekend. I will see you next week. I'll look for you in my future webcasts. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.